Jai Yanendra, everyone. Hope you're all well, keeping safe, and looking forward to the warm climate, warm weather, I should say. Welcome to you all for the second in a series of our financial education webinars. Our goal is to educate and inform people of what is available out there, as well as inform people of things that they should be looking at. Today's topic is financial awareness for the younger generation. And we will explain a little bit more, but if I just tell you a little bit about myself and Vinay. Vinay, I think, I'm not sure if Vinay is spotlighted or not, but yeah. Right, here we go. Vinay and myself, we've been financial advisors for over 25 odd years. We've got a wealth of experience under our belt, and we want to just share some of that knowledge with you all and hopefully make some difference to people's financial planning future. We will take questions at the end of the seminar or webinar. If you do feel that you want to ask a question, do write them onto YouTube. And if you feel that some questions are a bit, you want to remain anonymous, you can always put them in via email, and we won't disclose your name, oshwalweb@oshwal.org. So please do ask questions and we will take them at the end. So we've got some dates for the following six remaining webinars. Next one is on 20th of May, which is what is an ISA, which in itself is quite, it will take 2 minutes, but there's a lot more that we will share with you on that day, and obviously the others. We're later time of 8 o'clock, and we are looking at doing them monthly, as we had some feedback that it was a little bit too quick coming around. So everybody needed some time to digest the information that they got. So without further ado, we're going to take about 35 minutes, and then we'll take questions afterwards. So I'll start off with the initial things, and we'll pass on to Vinay after that. So financial education is key. There isn't really any education for children in schools and colleges. So they come away with really no knowledge unless parents have taught them something. And more often than not, children don't always listen to parents, as I know full well. So teaching in schools and colleges is absent. So one of the surveys that you see in front of you on the screen, 94% of the secondary school teachers agreed that this financial education is an essential life skill, but yet it's not part of the curriculum, and most people are left to flounder. And we know we get inquiries, and sometimes we get asked questions which we think that people would know, but they don't, because they haven't been taught. They haven't learned. So, and 80% of the teachers believe that outside help is needed. So in some way, we're trying to address those, one, by these webinars. Secondly, Vinay and myself are going to be looking at going to schools and colleges and workplace to help with those programs and help with financial education. So if you've got anybody in the schools or colleges want some help, do get in touch with us at oshwalweb@oshwal.org. So without further ado, I've covered the initial part. I will leave it to Vinay to take over the next part. Vinay.
Brilliant. Thank you, Paresh. Next slide, please. So one of the questions that's always asked is, where do I start? Financial awareness, education is not something that comes naturally to a lot of people. So we've got some tips and ideas as to what you can do in order to make a start with these things. So first things first, we would suggest is, if you could go back a slide, please. Yeah. So first thing is, we would say that you need to set goals, both personally and financially. And when we say set goals, we mean things that you should think about, things you want to achieve, or goals that you want to get to in 6 months, 1 year, 3 years, 5 years. Look as far into the future as you can. I know it's a difficult one, but it's always good to have some idea of what you want to achieve in, as I say, 6 months, 1 year, 3 years, 5 years, and try and stick to them. The biggest thing is we make goals personally and financially, and it's very difficult to stick to them. But it's very important that once you've made the goals and you've committed to them, that you stick to them. The other thing is you should write them down. What we found is that sometimes people make these goals, but if they're not written down and if they're not available visually, it's very difficult to keep reviewing it. It's very difficult to go back to them and reassess whether you're on track, whether you need to make some changes, things like that. So we would say keep the list somewhere where you can see it all the time. It's very important to do that because visualization, as I said, is a very important part of the whole process of becoming more financially educated. Plan for the future. It's a difficult question when people are young. People think that the future is many, many years in the future, and it's not something they need to think about now. But believe me, it comes around really, really fast. So, time goes very fast, as everyone says these days. Years, months, weeks go past very, very quickly. And if you're not prepared or have some idea of what you want to achieve, then it can be very difficult because you may have missed a few years not thinking about these things. You should review your plans regularly. If you don't, the saying is you plan to fail. So review regularly and make sure that you're on track. And if you don't plan, then it's very difficult to go back and review. The other thing is when you're setting targets, when you're setting goals and planning for the future, be realistic. There's no point in saying I'm going to do something completely unrealistic because ultimately when you fail, it'll not help you in the long run. It'll make you feel as if you haven't achieved the things you want to achieve. So make sure the goals are realistic, chunk them down. What I mean by chunking them down, I mean don't try and do everything in one go. Do little bits, small bits, and the whole will then happen. So, as much as you can, chunk it down to smaller and smaller bites, smaller segments, which are more and more achievable. And overall, over time, you'll find that you start getting more of these things sorted out or achieved. One of the biggest things to one of the biggest things to financial education is budgeting, something that very few people do very well. We would suggest that as a starting point, have different pots for things such as holidays, long-term savings, emergency money, social expenses. Add to these pots regularly and don't spend beyond your means. What we mean by that is unless you have the money in your pot, wait until you have that money and then go ahead and spend it when you've reached your target. It's too easy sometimes to take money from one pot, put it into another pot because we want things today rather than wait till tomorrow. So just be mindful that when you set goals, set budgets rather, stick to them. Try and find a mentor. Now, this is something we've said to many people that, if you don't have a mentor, someone you can basically look up to or someone you believe would be able to help you and support you in your journey and provide you with encouragement and pearls of wisdom, it can be a difficult journey. You always need to have someone you can bounce ideas off, people that you can, when you're worried, when you're concerned, when there are things you're not sure about. Some people as mentors, as good mentors can provide you with that assurance and assistance when you need it. So just see if there's someone within your friend circle, within your family circle, someone you look up to that you can basically, who would be happy to be your mentor, because it's very important. Next slide, please. So in order to budget properly, what we would say is that find a template that works for you. There's plenty of different versions of templates if you go and Google them, or if you look at Microsoft Office, there's plenty of different versions. This is a bit busy slide, but the main point is that what we're trying to say is that there are different versions of it, but use the one you feel most comfortable with. It's an important part to be able to visually see everything. And then what will happen over time is when you set budgets and you look back at them and you revisit the numbers, you'll start to see there are things which you may be spending too much on, things you're not spending enough on, and adjustments can be done. But if you don't do the budgets in the first place, then it's very difficult to know whether you're spending your money in the right places at the right times or on the right things. So just be mindful of that and do as much as you can in terms of budgeting. It's really, really important. I mean, Paresh will probably tell you the same thing, that a lot of the things that we do for our clients as financial advisors is around budgets, because ultimately we need to understand where you're spending your money in order to help you to achieve some of the targets or goals that you're looking to achieve in your journey. So just be aware of that. I'll pass it back to Paresh to go through the next part.
Thanks, Vinay. Vinay's right about budgeting. That template, we've got copies that we can share with you. So if you do, if you struggle to find it, that template, we can just send this, and it's quite a nice way of keeping track of your income and expenses. And if, as Vinay said, if you don't know where you're spending it goes, you won't be able to keep track of it. So I think measure it, where it's going, where it's saved, where it's put. So I think it's an essential part of budgeting, and it applies to everyone. I've just had a message from somebody saying, who is the younger generation? My answer is anybody under the age of 90. So so it is, everybody can learn something from this. So really the objective for most people young people is to go to university, education, work, and then get onto the housing ladder. That's the first thing that we're all conditioned into thinking and doing. So the biggest issue with people these days is having that deposit to be able to purchase something, and it's a key element. The bigger the deposit, the better the rates and easier to get a mortgage. But finding that initial deposit is difficult. And where do they go? Usually it's bank of mum and dad to help them along the way. There are obviously lots of schemes out there which we'll cover in a later webinar when we cover mortgages. But that's one of the things is you get your mum and dad. Obviously, people have saved up themselves as well. If they've been to university, probably not, because they've got a big debt which is looming there ever. Now the other challenge is income. Not everybody has sufficient income to afford the prices, especially in and around London. Outside London, maybe so, but the income needed. So what happens is you buy with a friend, club together, and buy a property with the help of mum and dad. One of the other things that tends to happen is you can get parents to be a guarantor on a mortgage, what's called joint borrower sole proprietor. So that's another way of getting your foot on the property ladder. The quick questions you will always have is affordability, and that's the key at the moment with lenders. Although there may be 95% mortgages around, but we need to be affordable in the eyes of the lenders, not necessarily you and me. We think we can afford it, but the lenders may think otherwise. One of the other things obviously people are doing is buying with a partner or to-be partner, buying a property before they get married, and then before they get married, so they've got a property before they once they get married, they can move into that. That's joining up two incomes, either with a friend, with your partner. You can do that, and that parents normally can give hopefully a deposit to help them along the way. A joint deposit will be worth a lot more. So, Vinay, over to you.
Thanks. Next slide. So there are other considerations when you're looking at mortgages or looking at budgeting. A lot of people have student loans. Many people come out of university these days with large student debts. Anything between sort of 30 and 50,000 pounds is typical these days. Not so much with some of our community, but we see quite a lot. It's a very difficult start for someone young when you've got that sort of debt already before you've even started out, looking at your options and starting your careers or your journeys going forward. Couple of things I just wanted to mention on student finance, and that is, although the debts don't count towards the mortgage affordability calculators, you should look to pay them off as quickly as you can. The reason behind that is that most student debt have interest rates of interest that you pay on them. And depending on the type of student loan you have, currently the interest rates charged is either RPI, Retail Price Index, or the Bank of England base rate plus 1%, whichever is lower. So it can be quite a, it's not cheap. It's not a, one of the, it is a cheap way of, an expensive way of borrowing. So just be mindful of that. Normally with student loans, once you start work is when the student loans are normally paid off. As you start earning up to a minimum level of income, part of your salary will just be automatically deducted towards paying off your debt. But what we're trying to say to you is just be on the front foot wherever possible, pay off as much as you can, quickly as you can, because obviously ultimately it will sit there as a debt against you, which is costing you interest, and over time it becomes more and more difficult to pay it off. And we appreciate that obviously things have changed these days from the days when Paresh and I probably went to university, where you used to get government grants, but we don't get that anymore. Paresh, if you want to have a look at the next part, please.
Vinay, I think you're right. When we went, we were given money to study. I think not these days, unfortunately. And I'm reminded of that by my son quite often. So yes, it's a different world now than it was back then. Things were a lot cheaper back in those days as well. So credit cards, it's a huge benefit and a curse to people. We've got people who come to us with credit card debts, and then some who are very disciplined that they will know down to the penny how much they have in the credit card, how much they'll pay off. So two extremes. So one thing is we'd say is don't use the credit card for purchases that you can't pay off at the end of each month, because they are an expensive form of finance. Normally, student credit cards can range from 16 to 20%. Student credit cards are obviously cheaper, but it's one thing which is credit cards are very, very, as I say, flexible friend, but it can be quite a detriment to your finances as well. Making payments on time, crucial. If you make payments on time, your credit score will build up, and it will give you a boost up when you're looking for properties or any kind of finance in the future. So it's good to have a good credit score. One of the things that we haven't mentioned is credit. There are so many credit agencies out there. You can check your credit score, and it's good to do it regularly on those sites. I won't name them, but you will know them. There's advertised on TV. So do look at those, and they're free. So you subscribe free, and you'll get a monthly report and alert if there's something happen on your credit file. So keep an eye on your credit. That's really essential, because one missed payment something gone wrong that can affect your ability to borrow money. Common things used to happen is students have been at university on their student accommodation. They've not paid their broadband or something of that nature. They haven't paid it, and there we go. It's been lodged against their name, and it can affect them for a long time. So always keep an eye on your credit file. Again, look out for credit cards which are 0% or low interest. If you have to have debt, look at them, keep changing them, keep looking at them. And when you don't use a credit card, it's best to close it off. Close off the credit card, so that otherwise credit file looks at it and say you've got 4 credit cards, you've reached your debt ratio. So always, if you're not going to use a credit card because it's too expensive, write to them, just close the credit card altogether. That way you're maintaining a good score, and your ability to get another credit card will be enhanced as well. And credit card limits, credit card company will keep upping your limits unless you tell them. But now they do give you a choice. Do you want us automatically to lift your credit, or do you want us to write to you first? So I always say, look, you choose. Be in control of what the credit companies do. They're there to make money. So your job is really to try and minimize that and use the credit card. Credit card's a wonderful tool. 56 days of free credit potentially you get. And, there's some rewards as well on various credit cards that you will get. So I think best, really, my advice would be to just use the credit cards, use it carefully, build up your credit score as much as you can. Look at those credit file, keep an eye on it, subscribe to it. They're monthly. They will send you offers. You don't have to take any of those, but sometimes an offer might be good for you to do that. That's how they earn their money. So do keep an eye on it, and use credit cards wisely.
Okay, so just moving on from there, one thing on the credit cards that wasn't mentioned is when it comes to mortgages, just be aware that any credit card debt is deemed to be an expense against your salary, and therefore will have an effect on the amount you can borrow when you're looking at mortgages. So just be mindful of that as well. So as we said earlier, the biggest thing that people face is savings, how to build up savings. It's not easy when you've started working for the first time, possibly, to build up enough savings for deposit. Bank of Mum and Dad, we mentioned before, is one option, if it's an option. But be mindful that just generally speaking in the UK, in 2020, the average person in the UK had saved £6,757, which really isn't a huge amount of money. A third of Brits have less than £600 in savings, and 41% of Brits don't have enough savings to live for a month without income. These are quite dramatic and stark comments that I'm making, but even with the pandemic and everything else that's happened recently, you can see that so many people are now having to rely on food banks and other things. So, we just have to be mindful of that. I appreciate that within our community, generally, that's not the case. I'm not saying that is for everyone, but generally speaking, we're not living on the breadline in many, many ways, and that's a good thing. But just be mindful that the actual amount of savings that the country actually has is very, very minimal in comparison with other countries. As a guide, we would always suggest that you look to invest or save at least 20% of your salary, net salary. That's after your taxes and everything else are paid, to build up your savings pot as much as possible. So that's a typical guide that we use when people ask us the question, how much should I typically be looking to save every month? So that should give you some idea as to the sort of levels that we encourage people to have a look at. Next slide, please. Paresh.
Yeah. one of the other things we also get asked a lot, and it's not a lot of young people will buy protection, life cover on critical illness. And, we kind of think that if you have commitments, such as a mortgage, it's always best to have some life cover and critical illness, one, to cover the mortgage, and two, also anything, if you've got dependents, to have income for them. A lot of the time, people, obviously, when you're young, you're never going to die, are you? So you're immortal. So it's, unfortunately, people do die, people do get ill, and it's something that we say that you should look at doing some cover. And you see in front of you costs of cover. I'll start with the bottom part first. Life cover for a 30-year-old, for 250,000 to age 75. That's 45 years of cover. It's £14.86 per month. And you'll have paid 7,846 over that term. Now, when you think about the amount that you'll get back if something happens to you, and your mortgage may be paid off, something for your family, that's worth having. And remember, as you get older, your health changes. Sometimes it stays the same. It's good health, but we know people get ill. The cover at that point will be more expensive to buy. So as you can see, the second part, somebody age 40, the cover is 26. It's still not that expensive when you consider what you're getting, £250,000. People will say, I'll be paying money for nothing, but if you don't need this cover, you can cancel at any time. There's nothing to say that you need to keep the cover. It's like car insurance. You pay that every year, and you pay, £500-600 a year. If you don't claim, you don't get your money back. But if you do need to claim, it is there. It's helpful. The only thing is it's compulsory. That's why we buy it. We don't buy life cover. Why? We don't know. Why? People think they're never going to die. They're not going to get ill. Unfortunately, people do. Give you an example. A friend of mine, who was my ex-business partner, both of us took out critical illness cover at the time we started the business. Unfortunately, had slight mild heart attack. Paid out £100,000 to him. So he's happy, and he's healthy now. But what he did was take that stress off his mind that he didn't have to pay the day-to-day bills. This is where it comes to critical illness cover, and that's more expensive, as you can see above. £250,000 for a 30-year-old. The cost is £203. Now, that covers what critical illness means. It covers your illnesses such as heart attack, cancer, paralysis, stroke, many other illnesses, but those are the kind of the core illnesses that most of these critical illness plans cover. It gives you cover, £55,000 it will cost you for 45 years, but it will pay you £250,000. And similarly, for an age 40-year-old, see the cost almost doubles. 10 years later, the cost doubles. And at that time, you may not be able to get cover at that cost. So really, really important to look at some sort of cover. There are various different types of cover. We just mentioned two as an example. There's decreasing cover, which is people take out when they take out mortgages. There's family income benefits. Lots of different types of cover, but it's essential, whatever you do, if you've got some commitments, you've got some dependents that you rely on you financially, do take out some cover. That's important. Vinay.
Thank you. Yeah, I think also one point to add on that is if people delay, which is what we're trying to say, if you're age 30 or age 40, there's a big difference in the premiums, even if you're fit and healthy. So just bearing that in mind, the older you get, the more expensive the cover gets. And therefore, it's always wise to take out cover when you're younger and fit and healthy. So just moving on to building up your savings. We would say that invest in the stock market via the stocks and shares ISA rather than a cash ISA. Typically, what we tend to find, a lot of people have money sitting in cash ISAs, and a lot of people nowadays are probably aware that cash ISAs don't pay a very great rate of interest, and therefore you're not making the most use of your savings. And we would say that wherever possible, invest in the stock market through a stocks and shares ISA. This graph that we put up here just shows you that if you put £1,000 as an investment in 1986, and if the interest rate had been anything between 1% and 3%, that £1,000 over a period of 35 years would be worth anything between £1,400 and £2,800. When you compare that, if you'd invested that money just in a FTSE 100 index over the same period of time, it would have been worth £18,800. So there's a dramatic upside. But as you can see, the journey is different. One is very stable, just carries on sort of ticking upwards every year, whereas one obviously goes up and down with the markets. So be aware that obviously markets do fall, markets do go up. But overall, what we're saying, the longer term you can invest, the better the returns can be. So just something to bear in mind. Except the risks, we would say, when you're investing in the stock market. There are risks, but take guidance if you're not sure, and accept those risks because they are there. But as you can see clearly, that it does, if you do invest in this way, it does reward you in the long run. The other factor to remember is the younger you are and you start saving, if stock markets do fall, then you have time to recover. If you're in your 50s or 60s and you're relying on this money and the stock markets change at the last minute, it can have a very dramatic effect. Whereas if you're in your 20s and 30s and you're not necessarily in need of that money immediately, then we've found that whenever the markets have fallen, given time, markets do recover. So it's just one of those things to bear in mind, not to panic when markets fall, which is something that sometimes people do. And it's probably the wrong thing to do. We would also say that the stock markets do move up and down sharply, and it's natural for investors to be concerned. And the other factor is that a lot of people worry about getting the timing wrong. We would say that investing a lump sum one day only to see share prices fall significantly the next day is obviously not going to be a great journey for you. But we need to be bearing in mind that these are all longer term ways of investing. And investors cannot consistently and successfully time the market as well, which is something a lot of people try and do. You might be lucky when you invest a lump sum, but nobody really knows what the stock markets will do next week, next month, next year. However, that doesn't matter if, for example, you're saving for a pension and you don't intend to retire soon. Taking a long-term view is what matters most. One way to reduce the worry of investing at the wrong time is to invest on a regular basis, drip feed money into the market, because then you're buying units in an investment where the share prices go up and down, and therefore the amount of units you can buy for the same amount of money every month is different. But over the longer period, those cheaper units offset some of the more expensive units and generally give you a better return over the long term. Something known as pound cost averaging, a term that's worth looking up if you're not aware of what that is. The other thing that we always get asked about is it the right time to invest in the stock market? We would say that time in the market, not timing the market, is the key to investing. It's only natural to be concerned about short-term fluctuations. We understand that. But the only certainty is that it's impossible to be sure how the markets will move. So you've just got to invest and just keep faith with that investment. And if you're in the right areas of investment and you've got the right guidance over the long term, it will normally do very well. The other thing is also to remember that there are stats that we are aware of, that even in a 20-year period, if you invest your money and you miss the best 40 days in the market, that can dramatically affect the amount of returns that you achieve over a 20-year period. And it can be significant, anything up to 50% less as a return. So therefore, what we're trying to say is, don't try and time the market, just invest for the long term. And I'm going to keep repeating that point. You know, if you miss those few days, the 40 days out of 20 years, it can have a dramatic effect on the amount of money you'll receive back. So just bear that in mind when you're looking at markets. Always being asked about that, when's the right time to invest? The other thing is also you have different ways of investing. It's not really about what's right or wrong here. It's about a lot of people think it's okay to go online and DIY, do it yourself. And sometimes it's not always the best thing if you're not sure what you're doing. So I think advice is key. Speak to people who invest in the markets, speak to advisors, get an opinion before you make that decision as to which is the right route for you. It's about taking the right advice, especially when you're starting out. Paresh? Next slide, please.
Thanks, Vinay. Nicola, could you just go back to the previous slide, the chart? So I think, as Vinay said, look, it's being in the market rather than timing the market. If you look at the last part of the slide, just before the pandemic, the market dropped suddenly, and the value of your investment fell. But now it's almost to that pre-pandemic level, and as things continue to start to open up, they will start to get better. So you see there's a couple of dips there. One is in the .com bust, which was around the 2000, and then in 2007-8. So every dip it's recovered from in the market, and we're only talking about the FTSE 100. So if it was we have a graph which shows the world index, which is a lot different, and this also means that what we've said in the previous one is diversification of assets in different asset classes and geographic locations. So it's something that to bear in mind. So thanks, Nicola. So according to Einstein, the most powerful force in the world is compound interest. Now, compound interest is for saving is really powerful. To give you an example, £10,000 invested today, if it grows at 7% a year, and you keep reinvesting, in 30 years' time, that will be around £70,000. Now, that's a lot of money without you doing anything but reinvesting the money that you have. Any dividends you get, any interest that you get is reinvested, and it'll be growing. So it's one of the things that we would advise is that, reiterate what Vinay said, time in the market, not timing the market. So being in the market for 30 years doubles your money. However, if you took the money out, all the interest and dividends out, it would leave you about £20,000 after 30 years. So you have made money, but not as powerful as if you'd left the money in for 30 years. Obviously, we're saying that the interest generated from the dividends, if you'd invest in any of the companies, they will all pay dividends. Dividends reinvested give you growth, as well as share prices increasing. So compound interest is a powerful tool, and it's something that we all need to understand the benefits of. If you keep putting money in regularly and it's growing for you, it will get to your goal. There are some tools on the web, on the internet. Have a look at the power of compounding, how quickly things grow, how you can reach the goals that you want. And as Vinay said earlier, looking at setting the goals. How much do you want? Do you want £10,000 in 5 years' time? How much do you need to save now? How much do you need to save? One of the things that I came across a couple of days ago was, if you start saving a penny a day, penny today, 2p tomorrow, 3p the day after, and so forth, in 365 days, you'll have £600. So that's really very easy to do. Put a penny away. I know it's some small things, but that's how it works for children. If you teach them that, look, put a penny away each day, penny, then 2p the next day, they will have £600 at the end of the year. And that's a really powerful tool for everybody to understand, and that you can change that penny to £1 to £10, whatever your ability to save are, and the result is quite powerful at the end of the day. Vinay?
Yeah, thank you. So the other thing is the importance of saving from a young age. A lot of the times we get asked by younger generation of people, I can leave it. I don't really need to think about these things now. It's 30, 40, 50 years in the future. Why do I need to start saving now? So we've just given you some idea here where basically if you invested £10,000 into a pension scheme at the age of 30, subject to certain projections and assumptions, that amount of money will be worth in excess of £450,000 by the time you are 60. The issue you've got is that if you delay making that investment for 5 years or 10 years or 15 years, as the slide shows there, the amount of fund that that you'll get back is considerably reduced over those timeframes. And the longer you delay it, the more reduction you'll obviously see. But also in the right-hand column, you can see that the amount you'd actually have to pay in as extra to get back to the level we would have done in the first instance is quite a dramatic amount. You'd have to start paying more. And it's quite difficult to do that with a shorter time frame as well. So, just be mindful that saving something early, saving something young, and just keep getting in that habit of doing that on a consistent basis is really, really important. Otherwise, it'll become more and more expensive to get to the same target as the years go on. So again, putting it another way, 25 years to retirement, 22% reduction in the fund, 20 years to retirement, 42% reduction in the fund, and 15 years from retirement, 60% reduction in the fund, as those pie graphs show there. If you're working, make the most of the pension schemes. We talked about it last time. Pension schemes now have become mandatory in many employed work, and you should try and contribute as much as you can into the pension because it does build up over time. If cash flow is a problem, we're not talking about putting lump sums in, even start doing something monthly and just build up as and when you can. Every bit helps, and it works over the longer term, as we mentioned about compounding earlier. Just remember one last thing, and that is in the old days, people used to always say the state will provide. I don't think anyone today can really say that the state will provide the type of pension or the type of income that we want to see in retirement. And to believe that the state will provide is probably nothing, it's not worth even thinking about. More and more as time goes on, most people will have to make their own provision when they retire, etc. And I agree, I do get it that as a young person, possibly thinking about something 25, 30, 40 years away can be quite difficult. But as I say, over time, just getting into the habits of doing things regularly is a good start, and one that you should try and do as early as you can. Thank you. Paresh?
Thank you. You could next slide. So I think we've covered all the topics we wanted to cover. It's a whistle-top tour of things. We're not going to be able to cover everything in this webinar, but I think the first line says it all, really. Education is the key in all of this. Use the tools that are out there. There's plenty of free tools out there available, free resources available, which will come in the next slide in a minute or two. Use those resources. Start early. The earlier you start, the better you will have. It might be something now you sacrifice, but for a better future, As Vinay said, set your goals, make them realistic, plan ahead, and get a mentor. Save regularly. I've just said, if you'd use the example, it's a very simple example that I mentioned. I think it's a powerful one that will help you, your children, your family to budget. And think about credit cards and loans, as Vinay said, it does affect the ability to borrow. So don't use credit card or loans for anything than the essential that you need. And lastly, invest for the long term, but be aware of the risks. Risks are there, but you will benefit for thinking long term. And so, next slide. So resources, as we mentioned last month, Money Advice Service. It's a brilliant website, lots of free resources, budgeting tools. You can download some stuff from there. Also, there's another website, choices.sjp.co.uk. Again, it's nothing about products. It's about educating people about personal financial planning. And if you haven't read this already, it's a book highly recommended that everybody should read, Rich Dad, Poor Dad, and it teaches you about investing and how to do it and what you should be thinking about. And it's an easy to read book, so highly recommended. I think it's sold so many millions of copies around the world. Lastly, if you've got any questions, we've got some questions which we'll take in a minute. But if you've got any questions after the webinar, do drop us an email on oshwal@oshwal.org. We had quite a few from last time, so which we've answered. But if you've got any questions, do feel free to ask us. Thank you.
Next slide, please. So just to finish off, we're just going to do some question and answer. I see in the live chat there are a number of questions there. So, Paresh, shall we start picking those off, please?
Yeah. So first one is Rupen is saying, Vinay, Paresh, thanks for taking the time to run these webinars. Are you connected with Keith Richards, CEO of Personal Finance Society? I believe his organization runs a pro bono education at schools. So I think there's lots of financial services company doing this, and yes, I think everybody realizes there's a gap that needs to be filled, which isn't being filled by schools, and it's not part of the curriculum. So I think that is something a lot of people are doing. Although I don't know Keith Richards, but yeah, it's there. So the question from Mayur is: Did you say pay off the student loans?
Yeah. So we would suggest that wherever possible to pay off the student loan. There is a following question to that as well. That is it wise to pay off the student loan or as soon as one can, or is it better to start saving to get onto the property ladder? That is a $64,000 question, unfortunately. Whether you should pay off your debts first or whether you should try and save up, I think it's best to have a combination of both wherever possible. Pay down your debts as quickly as you can, but also save to build up a deposit. It's difficult to understand, but then budgeting, as we've said earlier, is a really big, powerful tool in terms of achieving both wherever possible. So Mayur and H. Shah, I hope I've answered your question on those. And another following question that H. Shah has asked is, one might not get help from parents, so what is better to do?
I think that's a valid question, because I think not all parents will be able to
help their children.
Help their children. So sometimes you have to make do with what you can, make the best of everything possible. So it is a difficult one. Yeah, you may not get help from parents. They're not able to. So it's understandable. Yeah. And there's nothing we can do. But in a session on mortgages, we will cover different ways you can get help and how you can get onto the property ladder. There are plenty of help available from the government or initiatives from the government, so that would be there. Kethan is asking, one thing I don't understand for critical illness, does the cover stop if a claim is made for, oops, it's gone off.
For the maximum amount, or does it continue
with a higher premium?
Yeah, so normally what happens is when you make a claim, the full amount is normally paid out depending on different plans, they do have different things, but normally it's fully paid out and the premiums then cease and the cover ceases as well.
Rupen is pointing to a money saving article on student loan repayment based on earnings. So it's worth reading that. Bhavin's asking, are there any recommendations for savings for under 18s?
Yeah, so we'll cover this, I think, in the next session, which is around ISAs, but junior ISAs is a very powerful way of investing for young people, and so is pensions, depending on how long you want to invest for and how much you want to invest and what's your purpose for investment. But as we mentioned earlier, cash ISAs is probably not the best place to invest given the current rates of interest. Paresh, I'm sure you've seen them. I've seen rates as low as 0.003 in the investment accounts these days. So, I mean, it's just crazy. The rates are very, very low for savers. Good for borrowers, but not so good for savers.
One of the questions which we're not going to be able to answer, or Kishavarya, is which platform is good for DIY ISA? Unfortunately, we're not going to be recommending any providers on here. You'd have to do your own research or speak to somebody. There are plenty of tools out there, and there are plenty of DIY platforms out there. Nikhil is saying, thanks for a great talk. You speak about financial education in schools. Are there any plans to educate people of all ages about cryptocurrency and the importance of decentralization?
Great question. Yeah, I mean, the education piece is something that we are both quite looking forward to and engaging in with all age groups as well. In terms of cryptocurrencies and the importance of decentralization, probably a bit of a deeper conversation to be had, and it's something that we can probably take offline, but we both have thoughts on cryptocurrencies and things like that, which we'd be happy to answer if you'd like to contact us, Nikhil.
Yeah, I think, again, a follow-up question. I think Nikhil is saying that, feel like people in the community don't understand what it means and why it might be important in the future. I think, Nikhil, the answer to that is, I think we're trying to get people to understand the basics of financial education, and, cryptocurrency is quite way above that. And, a lot of people don't understand it. Even those invested in things like that don't understand it. So I think our aim is to get people to learn about the basics of finances and then move on from there. There are plenty of, again, tools out there on cryptocurrency, but it's not something that we are equipped to do that, and I don't think we can do it justice either. When interest rates are low, is it wise to save and invest or reduce mortgage debt? From Jinal. That's a good question.
So yeah, I mean, interest rates are low, and for that purpose, obviously, it depends what you're trying to achieve is probably the simplest answer to that question. So saving is always important anyway for the long run, because ultimately we're all going to need money for something in the future. And with interest rates where they are, there is a conversation around whether you should pay off your mortgage early or keep the mortgage. But again, a question which I think you need to take advice on depending on different people's circumstances, and not one that we can really answer on here as a forum, but certainly would take advice, speak to us offline, I would say. There's a question from Ketan.
A SIP's a good product to invest into if you're self-employed.
Again, a question which is down to your personal circumstances. And as I say, today is really more about the basics of saving rather than specific products, whether they're good or bad. But certainly if you want some follow-up to that, Ketan Shah, we would be happy to take that offline.
I think on the SIP, I think it's not the SIP itself that whether it's a good investment or not, it's what's underneath it, what you're investing. So I think there's a misconception that SIP will be better or than a personal pension. I think what people need to understand is what makes up a personal pension, what makes up a SIP. A lot of the times people will have SIP and cash sitting there, which isn't doing anything. So whereas in personal pension, it tends to be remain invested. So something that, as Vinay said, something that is something that we can't answer without sort of looking at what the individual is looking for.
There's a couple of questions from a lady called Anua. I hope I pronounced that properly. For shares, ISAs, how we choose where to invest, and then also how to choose tools for investment in stocks and shares. Again, I would say take advice, seek out a financial advisor or someone who can give you advice on those things. But certainly, drop us a line if you want to have a conversation regarding that offline, I would say.
Yeah, I think it's, when you're not sure, always speak to somebody who does. And as we said, we've shared the free resources that you can tap into. Money Advice Service, it's a free service, so you can ask questions there and get an idea. And I think this is all about educating yourself. By using those free resources, you will educate yourself, so you'll be better equipped to go forward. Final, Vinay.
Yes, what do you think of cryptocurrencies as an investment? I would say one thing, there are 22,000 different cryptocurrencies. It's really a difficult question to answer, and not one that we would advocate for people at this level or on this particular forum. But yeah, there are so many different options, and some of them are, not well regulated. Well, nothing is regulated in the cryptocurrency market at the moment, so something that we wouldn't advocate per se for everyone.
Yeah, I think it's a very much an individual choice at the moment, and we don't know the stability of some of the currencies either. So it's a very much an unknown. I'm sure it will become mainstream sooner or later, but until then, we've got to just be guarded on that. Other than ISAs and SIP, are there any other platforms where, as an under 18, I can invest?
None come to mind that would be value for money, but ISAs is probably the best one. I would say tune in next time rather, and we'll be having a conversation around that.
Junior ISAs, yeah, look out for that. So,
yeah.
Mansukh Shah, with the interest rates at 0.5 or less, why not park money in premium bonds?
Yeah, so premium bonds is probably a lot of people have heard. The interest rates, basically NS&I have changed some of the sort of platform around in terms of the chances of winning a share of premium bonds. The chances and odds have changed dramatically. So yeah, it's definitely another option, but it's one that I would say is do the basics first and then look at these sort of areas where possible.
Yeah, I think I would agree with you. It's premium bonds. One of the things we suggested, and I think one of the things that you've suggested earlier on, is to keep an emergency pot of money. And this is a premium bond's a good place to park your money, which is safe, secure, accessible, and it's not going to lose value. It's going backed by the Treasury, so it's a place where you can keep your money safe. Those money that you'll need in an emergency for, a rainy day, something like that. There's said 3 to 6 months of savings you need, or maybe a year. So
yeah,
that's fine. So
a couple of questions from Nix. Isn't saving for the future one of the biggest strengths of the Oshwal community, and when compared to the general public? Yes, totally, Nix. I do agree with you. We do see a lot of, generally speaking, our community saves very, very well. The issue we've got now is the way you're investing and where you're saving that money is possibly something that's worth considering. There are a lot of options out there. Inheritance tax, other things come into play. We are good, as I say, as a community at saving, but there are two ways to look at everything. One is saving, and one is also getting to a point where you can enjoy your money as well. So there is a bigger, deeper conversation to have around that.
I think next, the other side of the coin is also the habits of people have changed as well, whether it's Oshwal or community or else. There is a change of habits, and we do see credit cards, we see debts, and for various reasons things happen. So although we'd like to think that Oshwals are communities good at saving and in their DNA, but it's not always the case, unfortunately. So this is this is another route for us to try and educate people or help people. So but habits are changing. So Mahesh Bhai and Bhavin Bhai are both saying thank you for the talk, and Kishore Bhai. So yeah,
welcome.
So I think the last comment was government bonds. I know, so government bonds. Yeah, it's gilts that you could invest in, but again, their interest rates are pretty poor. But I think we'll take. I think that's the end. I don't think I've got anything else. Have you got anything, Vinay?
No, I think it's been a pleasure basically running these events. I'm sure Paresh will agree,
Yeah.
and we are very grateful for the support that we're getting as well, and the comments, positive comments we've received. So very much appreciated, and thank you. I think we're just about out of time now, but as you say, there's a series of other ones coming along. So please feel free to join us for the next one in the series, which I believe is in about a month's time.
So I just echo what Vinay said. Thank you for all your support and questions. There are good questions, and thank you for watching. Just like to thank Hemal and Nikunj in the background. They're helping with the slides and making sure the questions are coming out. So thank you for that. So I think, as I said, do drop us a line if you've still got questions. oshwalweb@oshwal.org. And next one is on 20th of May. What is an ISA? So thank you very much. Have a good evening. Good night.
Thank you, everyone. Bye-bye.